stocks and investment strategies to consider during a period of rising interest rates. Today, I would like to introduce stocks and investment strategies that investors may consider during a period of rising interest rates. In the stock market, interest rates are one of the most important factors that determine corporate valuations and investment decisions. In particular, changes in benchmark interest rates directly affect companies' financing costs, consumer sentiment, and investment conditions, becoming a major factor that influences overall market trends. When interest rates rise, the cost of raising capital increases for companies, while the present value of future expected earnings may decrease. As a result, investors tend to focus less on companies with only a high growth potential and pay greater attention to companies that generate stable profits and maintain strong cash flows. 1. Financial stocks, a leading sector during rising interest rates. The financial sector is one of the first areas investors should examine during a period of rising interest rates. Banks generate profits mainly through the difference between deposit rates and lending rates. When interest rates increase, lending rates generally rise as well, which may lead to an improvement in net interest margin (NIM). This can contribute to improved profitability for financial institutions. When analyzing financial companies, investors should pay close attention to key indicators, such as net interest margin, loan growth rates, asset quality, and the ratio of non-performing loans. 2. Insurance stocks, a stable investment income structure. Insurance companies are another sector that may attract attention in a rising interest rate environment. Insurance companies invest premiums received from customers into financial assets, such as bonds, and generate investment income from those assets. When interest rates rise, the returns on newly invested assets may improve, potentially leading to stronger investment performance. Companies with strong asset management capabilities and stable, long-term revenue structures may demonstrate relatively stable performance, despite changes in interest rates. 3. Energy stocks, influenced by commodity prices and economic conditions. The energy sector is characterized by being influenced more by global oil prices and commodity markets than by interest rates themselves. During periods of economic recovery or inflation, rising commodity prices can improve the profitability of energy companies. Therefore, when analyzing energy stocks, investors should consider not only interest rates but also oil prices, supply and demand conditions, and the overall global economic environment. 4. Value stocks, companies with stable earnings. During periods of rising interest rates, investors often place greater importance on current earnings and financial stability rather than future growth potential. Value stocks generally refer to companies that generate stable revenue and profits while being valued at relatively reasonable price levels compared to their fundamentals. When evaluating value stocks, investors should consider important indicators such as the price-to-earnings ratio, PE ratio, return on equity, ROE, dividend payout ratio, and cash flow. 5. Dividend stocks, the value of consistent cash flow. During periods of increased market volatility, companies that provide stable dividend income may receive greater attention from investors. Dividend stocks offer investors not only potential capital appreciation, but also a steady source of income through regular dividend payments. Companies that have consistently paid dividends over long periods often demonstrate stable business models and strong financial structures, even during changing economic conditions. Growth stocks that may face pressure during rising interest rates. On the other hand, growth stocks may face relatively greater challenges during periods of rising interest rates. Growth companies are often valued based on expectations of strong future earnings. However, when interest rates rise, the discount rate used to calculate the present value of future cash flows increases, which can negatively affect company valuations. In particular, companies in technology, semiconductors, artificial intelligence, and other emerging industries may have strong growth potential, but their stock prices can experience greater volatility due to changes in interest rate conditions. Key factors investors should monitor to achieve successful investment results. In a changing interest rate environment, investors should not focus only on the direction of interest rates, but also analyze the fundamental strength of individual companies. First, investors should examine corporate earnings, revenue growth, operating margins, and earnings per share. EPS provide important information about a company's actual ability to generate profits. Second, investors should evaluate company valuation. Metrics such as the price-to-earnings ratio, PE ratio, price-to-book ratio, PB ratio, and free cash flow can help determine whether the current stock price is appropriately valued. Third, investors should consider the broader economic environment. Factors such as interest rate policy, inflation levels, employment conditions, and economic growth trends should be analyzed together. Investment strategy during rising interest rates. A period of rising interest rates does not affect all companies in the same way. The impact varies depending on each company's business model, financial structure, and ability to generate profits. Generally, during a rising interest rate environment, companies with stable cash flows such as financial stocks, value stocks, and dividend stocks may receive relatively greater attention. On the other hand, growth stocks that are valued primarily on future expectations may be more sensitive to changes in interest rates. Ultimately, the most important factor is understanding market changes and analyzing the fundamental value and competitiveness of each company. The ability to understand interest rates, economic trends, and corporate fundamentals is one of the most important foundations for long-term investment success.